Hi everyone. In this video, let's see about the overview of model tax conventions. Okay, it's basically between the articles stated in OECD MC and UNMC. That's OECD Model Convention and UN Model Convention. First chapter is about the scope of convention, where we discuss about the persons covered and the uh, taxes covered. Okay, so first, persons covered. Each for an application of a treaty, a person has to be a resident of one or both of the contracting state. For example, if India and China are enters into an agreement, then India and China would be known as contracting state. Okay. Then fiscally transparent entity. Income derived by or through a fiscally transparent entity under the tax law of either contracting states to be considered to be the income of a resident of a contracting state to the extent that income is treated for the purpose of taxation by that state as an income of resident of that state. For example, if a non-resident has an income, has a house property in India from which it he derives rental income, then what happens? That rental income is accruing or arising in India, and thereby it is taxable in India, right? So, like that, whenever there is a transaction is occurring in a contracting state, then such resident should be liable to tax for such income. That is known as fiscally transparent entity. Then taxes covered. Taxes on income and capital. Both taxes on income and capital. Income is like our salary income. Capital is like capital gains. Okay. The model conventions apply taxes on income and capital imposed on behalf of the contracting state or of its political subdivisions or local authorities, irrespective of the manner in which these are levied. It can either be just a common municipal duty or something like that. Then covers or coverage of taxes on income and on capital covers taxes imposed. What are taxes imposed? It could either be on total income, it could be on total capital or elements of income or capital. Only for part there is taxes and for rest it is not there. Okay, taxes included taxes on gain from alienation of movable or immovable property, taxes on total amount of wages or salaries paid. Okay, means it's transfer of ownership of property rights. Okay, when there is a transfer of ownership or a property rights, then what is that? Capital gain will arise, right? So that is known as alienation. From alienation, capital gain tax will be paid. Tax on total amounts of wages or salaries paid by the enterprises. Tax on capital appreciation. Okay, now chapter deals with definitions. What does it define? It defines who is a resident. Okay, like we have an income tax definition of a resident, here also we have a resident. Resident of either contracting state. A taxpayer has to demonstrate that he is a resident of one or both contracting state to be able to gain access to a tax treaty and avail the benefits therein. If so and so benefits are given in a particular tax treaty, then the taxpayer who is paying taxes has to prove to the satisfaction that he is a resident of either one or both of the contracting states to gain access to the benefits which are available in particular tax treaty. Meaning of a resident of a contracting state. Any person who under the laws of a state is liable to tax therein by reason of his domicile, residence or place of incorporation or place of management, any other similar criteria. Like we all know this, like residency is a resident of that particular country, or place of incorporation is for companies, or domicile is also for companies or artificial juridical persons, place of management for companies where it is actually located outside India, but management is covered in India, major management, that is top management are in India. Also, business decisions are taken primarily in India, or any other similar criteria. Any other criteria can also be covered for a taxpayer to be classified as a resident of a contracting state. However, this term does not include a person who is liable to tax in that state in respect of only income from others from sources in that state or capital situation therein. Okay. Then note, OECD MC does not contain reference to place of incorporation. What is the difference between this is the difference between UNMC and OECD MC. In UNMC, place of incorporation, while in OECD MC, this place of incorporation is not there. Then we have a tiebreaker rule. This is the frequently asked questions. And let's understand the order. When individual is a resident of both the contracting state as per the domestic tax laws of that contracting state, then his residential status shall be determined by applying the tiebreaker rule. What happens is that if some agreement is there and a particular taxpayer is a resident in both the contracting states, then what happens is that we don't know which rule to apply, right? Whether to apply income tax act or China's income tax act, right? Indian income tax act to be applied or China's income tax act to be applied, we don't know, right? So for that we have a tiebreaker rule, okay, which is as under in the following sequence. Okay, first one, permanent home. Then if then we have center of vital interest, then habitual abode, then nationality, then mutual agreement between the competent authorities of the contracting state. Okay, so let's move down to a question where there is this principle. Okay, the first test is based on where the individual has a permanent home, where he has permanent home. Permanent home would mean the dwelling place available to him at all times continuously and so it should be a continuous home and not occasional home, and includes place taken on rent even for even if you're taken on rent for a prolonged period of time. Okay, so first you can't identify the permanent home or permanent homes for a reason that individual has a permanent home available in both the contracting states. He will be considered as a resident of the contracting states where his personal and economic relations are closest. That is center of vital interest. Center of vital interest. Thus, preference is given to the family and social relation, occupation, place of business, place of administration, office properties, political, cultural, and other activities of the individual. So, first one is permanent home. If he has a permanent home in both the contracting states, then you should see the center of vital interest. Okay, then if their permanent home is available to in both the contracting states and it is not possible to determine the center of vital interest, or the permanent home is neither available, I mean it's available to him neither the contracting state. It means that you don't have a permanent home in both the contracting states, or you have a permanent home in both the contracting states and you are not able to identify or determine his center of vital interest. Then you will check the area where he has natural habitual abode, where he usually resides. Okay, then if the individual has an habitual abode in both the contracting states or neither of them, okay, you have in both or you don't have in either, okay, then you will be treated as a resident of that contracting state in which you have a nationality, that is national. If the individual is having a nationality of both or neither of the contracting states, then the matter is left to be considered by the competent authorities of the respective contracting states. The first one here would be the, like we had the order, right? Simplified order here. So what we had? We had, yeah, first one would be the permanent home. Then if you have it in both contracting states, then you will check the center of vital interest. If you have a permanent home in both the contracting states and you're not able to determine the center of vital interest, or if you don't have a permanent home in both the contracting states, then you will go with habitual abode. If you have a habitual abode in both contracting states or neither of the contracting states, then you will go with nationality. If you are a nationality of both, if you are a national of both contracting states or neither of the contracting states, then the matter will be left to the mutual agreement between the competent authorities of the contracting states. In case of companies, in case of it's for an individual, right? Now, in case of companies, dual residence arises where one contracting state is importance to the place of incorporation and other contracting states to the poem place of effective management. So one will have the place of incorporation. The primary head office will be there in one country, and that country will base its rule, that's a residential status, based on place of incorporation. While in India, what we focus is that place of effective management. The tiebreaker test involves a case-by-case approach considering the number of tax avoidance cases involving the dual residence companies. The request has to be made by the taxpayer through Article 25, that is Mutual Agreement Procedures, that is MAP. Okay, competent authorities will rely on the range of factors to resolve the ultimately given to the competent authorities to decide. Okay, this is what with respect to residence. Then we move on to permanent establishment. What is a permanent establishment? It should be an enterprise. It should be an enterprise. Such enterprise should also have a business. There should be a place of business. Such place of business should be at the disposal of the enterprise, which may be owned or rented, but must be one. It has the effective power to use, not own it, effective power to use. The POB should be fixed, that is, it should be established in a distinct place with a certain degree of permanence. That is with 5 years or 6 years for rent or lease something, or it may be owned property. The business of the enterprise is carried on a wholly or partially through its fixed place of business. So you don't move here and there, but you generally do your business from that fixed place of business. A PA does not exist unless all of the conditions are satisfied. All conditions, all conditions are satisfied. So PE, there should be an enterprise. Such enterprise should be carrying on the business. There should be a place of business. Such place of business should be at the disposal of the enterprise. It can either be owned or rented. It should be fixed, that it should have a fixed degree of permanence, and then it should either carry its business wholly or partially through the fixed place of business. Only if all these conditions are satisfied, then it means that you have a permanent establishment. Okay, now Specific inclusions. What are specific inclusions in the meaning of PE? That is, which means this will be considered as a PE. Okay, no matter what. Okay, it is like a branch, a place of management, an office, a factory, a workshop, or a mine, oil, gas, quarry, something query like that. Okay. So first is a branch. What is the next one? Which think office, factory, workshop, place of management, mine, oil, gas, well, or quarry. So all these will be considered as PE. They are specifically included. Expansion of scope of agency PE. Agency PE target activities done by a dependent agent of the enterprise in the source state. It is done by a dependent agent. He is not independent, he is a dependent. He is a dependent on the principal. Dependent agent PE now includes instances where agent habitually concludes contracts or habitually plays the principal loan leading to the conclusion of the contract routinely concluded without material modification by the enterprise. So this means that dependent agent means okay, this place will be known as where he usually enters into a contract or concludes the contract, and such contract will not be materially modified by the enterprise. PE for insurance enterprise. What is the insurance enterprise? Here we have a difference. So this could be a question. Okay. Whenever there are differences, there could be a question. Already we had, right, a place of incorporation is not considered in something. OECD, right? Like that. Okay, then UNMC and OECDMC has a difference here. PE of an insurance enterprise. UNMC has an additional article relating to insurance. An insurance enterprise of a contracting state is deemed to have the PE if the and the other contracting state, if it collects premium in the territory of that other uninsured situation, that therein through a person. If you do okay, when you said to have an P in other contracting state, when you collect premium or insures risk situated in that territory through a person there, okay, through a person there. Then OECD, in the absence of similar article, a P of the enterprise is dependent. So similar general principle will apply for OECD model, but in UN model it is specifically given. There is specific provision. Now, we are to chapter 3 where it is discussed about taxation of income. So, first one is the business profit. Right of contracting state to tax business profit. In OECD and UN model, business profits of an enterprise can be taxed only the resident states, when the resident state. Resident state, resident state, resident state. So taxation is based on resident state. I mean, sorry, business profit taxation based on resident state. Okay, right of source state. When source state will have the right, it will have only if P is existing in the jurisdiction. Only if P is there in the particular source state, then only the income will be taxed there. Once P is proven, then source state can tax only such profits as attributable to the PE. Only those income which are attributable to Indian PE can be taxed in India, right? If it's only branch or something is there, only to that extent where India has the place of business, permanent establishment, that alone can be taxed in India. And in US, UNMC, it is like the attribution principle is amplified by a limited force of attraction rule. It is like a rule, limited force of attraction rule. Okay. The FOA rule implies that when a foreign enterprise sets a PE in the source state, it brings in itself within a judicial jurisdiction of the state to such a degree that profits of that enterprise derives therefrom, whether through the PE or not, can be taxed by it. Accordingly, if the enterprise carries on a business in another contracting state through a PE, the profits of the enterprise may be taxed in other state, but only so much of them that is attributable to that PE, only that to that PE, sales in that other contracting states of goods or merchandise of the same or similar kind as those sold by through that PE. So either it can be directly to the PE or sales affected by the other country's PE, but in that similar goods should be sold there or other business activity carried on in the other state as those affected through PE. So any other business activity affected in that state. Okay, this is what covered under UN model. You have to apply. Okay, it can also be taxed, like entire income can be so taxed as source state. That is the principle here. And here it also states that, but only so much of them can be taxed. Either it can be directly in the PE or we are serving to that particular customers, okay, who are in the source state with a similar type of goods or merchandise services or other any business activity to that particular customer in the other state where we have the PE. Okay, then interest. Important one. We have questions on that. Right of contracting state to tax interest. Okay, it confers the right to tax the resident state to tax the interest. Right of source state to tax the interest. Generally, interest is taxed in source state at a given rate on gross basis. This is like TDS. We deduct, right? TDS we have for interest rate, that's mentioned here. That is given on a gross basis. Okay. However, if the beneficial owner of the interest is a resident of the other contracting state, the tax so charged less than or equal to specified percentage of gross interest. Specified percentage as per OECD is 10 percentage, but the UNMC leaves this percentage to be established through bilateral negotiations. Okay, generally what they say that is interest will be taxed in source state, like we have the TDS principles, right? So if it is the OECD, then the TDS rate will be equal to 10 percentage. Under UN model convention, it is left between the two contracting states to discuss based on bilateral negotiations. So whatever the rate of TDS they fix based on the bilateral negotiations, that could be the rate of TDS. Then definition of interest in OECD and UNMCs. Interest means this is exclusive definition. So this is what interest will mean. Okay, income from debt claims. Debt claims. No, equity will not be here. Okay, only debt claims of every kind, whether or not secured by mortgage, whether or not carrying a right to participate in the debtor's profits. So you don't, whether you have a right to participate or whether you have, whether it is secured or unsecured, no matter what, if it is for a debt, you are charging some income, then it will be known as interest. Specific inclusions in the definition of interest as per the UICD and UNMCs: income from government securities, income from bonds and debentures, premiums and prices attaching to such securities. So any premiums or some bonuses being given for that particular securities, bonds and debentures. Interest do not include the penalty charges for late payment. Penalty charges will not be included in the interest because it's a penalty, right? How could it be included in the interest? It's very common, right? So yeah, interest does not include penalty charges for late payment. Now, moving on to the next one, royalty. This again a case area where questions can be raised. OECD model. OECD model, royalty arising in the source state and beneficially owned by the resident of a resident state is taxable only in residency. Thus, residence has exclusive right to tax royalty income. As per OECD model, resident royalty will be taxed in resident state. OECD resident state. OECD generally it will be everything will be taxed. See, OECD principle itself is based on the residence. Okay, you can understand by that way. Unless and until you find somewhere, it will be generally resident state. Okay, UNMC is stated. Okay, you decide among yourself. It can also be taxed. Okay, again, if there is a beneficial owner in the residency, the tax again the TDS will be based on bilateral negotiations. Here if you remember, if the here on the other way also we have discussed, right? The TDS will be 10 percentage and in UN it will be bilateral negotiation. Similarly, for royalty also, on the gross income, you have to deduct TDS, which in UNMC is based on negotiations. Okay, definition. What is the definition? Royalty does not include. It is like you don't include these in royalty. Okay, let's first see royalty includes in the UN convention. Okay, it is rental for films, tapes used in radio or TV broadcasting and equipment rentals. Okay, here it does not include rental for film tapes and rental for industrial, commercial, scientific equipment. Okay, this is what it does not include. It includes. There's a difference. Okay, FTS, which means fees for technical service. Again, an area where questions are already raised. Okay, in book back itself you will find. In 17 update, the UNMC has inserted a specific article pertaining to fees for technical services. There is no specific reference to OECD MC. So there may be a question in MCQ which states that the rate of TDS for FTS as per OECD model. Then you have to say it is not determined. There is no specific reference given in OECD model. Okay. Then right of CS to tax FTS. This is only for FTS. If you think FTS should be only even. Okay. When things that they are so much very well good in technical service, right? So they are going to tax it. Okay, confers a right to the resident state. Again, this is a resident state. However, does not state the FTS is exclusively taxable in the resident state. So it states that again. It's like diplomatic answer. You decide among yourself. It says that it can be taxed in resident state, but does not say that only to be taxed in resident state. Establishes the right of the source state to tax FTS in accordance with the domestic law, subject to the limitation of the maximum rate of tax to be established with bilateral negotiation. Again, bilateral negotiation, but it will is a resident of the other contracting state. When the beneficial owner is a resident of the other contracting state, then it states that it gives the source state a right to tax the FTS, and where a maximum rate of TDS should be fixed based on bilateral negotiations. Meaning of FTS. FTS means payment for managerial, technical or consultant service. Managerial, technical or consultant service. So what is not included in FTS? Payment to an employee. Payment for teaching in an educational institution. Individual for personal use. Personal use will not be included then. Now, moving on to the next one. Capital gains. This article provides taxation from the capital gains as capital assets, including transfer of shares. Shares is also a capital asset. Right of contracting state to tax income from capital gains. The right of to tax capital gains may be exclusively with resident state or shared. The article does not specify what is a capital gain and how is to be computed. This being left to the applicable domestic law. The article contains rules for taxation of gains from alienation of different assets like immovable property forming part of PE, ships, aircrafts, etc. In respect of shares, UN and OECD model are identical. Rights conferred to store shares if more than 50% of the value of shares during the proceeding is derived from the immovable property in such source state. These are the things, okay? This is yet to be asked. Okay, so let's concentrate again. So here what it says that it can either be with our resident state or it can be shared by both of them based on bilateral negotiations. Second is that it doesn't clearly explain what does capital gain mean. So it is left to the domestic law to decide. Third one is that it contains a rule for taxation for gains between the alienation of property and so on. Okay. Then in respect of shares, both models state the same. Okay. Rights are conferred to the source state if more than 50% of the value of shares during the preceding 365 days is derived from the immovable property in such source state. If source state you have an immovable property and for that you have a shares, that shares you're selling it now and gain is arising, then you can tax that shares if more than 50% of the value is due to the source state. Okay. Now, moving on to the next one. Independent personal services. This article is only there in UNMC. So, FTS and independent personal services only there in UNMC, which deals with the income derived from the by a person for professional specified services which are offered in the source state through some presence. Some presence is there in the source state and they are going to offer that services. Right of contracting state to tax the income from professional services. Okay. Then income derived by residents of a contracting state in respect of professional of independent character is taxable only in the resident state, only in the resident state, only in the resident state. However, we have circumstances where it can be taxed in the source state. Okay, generally what even says that it is a bilateral negotiation, but in the case of individual independent personal services, it states that generally the income from professional services will be taxed in the resident state. However, in the following circumstances, it can be given the right to the source state. Circumstance. If he has a fixed base regularly available to him in the source state, if it has a fixed base regularly available to him in the source state, then only so much of income attributable to that fixed base may be taxed in the source state. If his state in source state is for greater than 183 days in any 12 month preceding the commencement of a financial year, then only so much of income can be taxable there. So only so much of income which is either generating there in source state or only so much of income earned in source state because of a stay more than 183 days, only that will be taxed in the source state. Then determination of professional service. What does professional services mean? It includes an inclusive definition, especially independent scientific, literary, artistic, educational, teaching activities, as well as the independent activities of physicians, lawyers, engineers, architects, dentists, and accountants. OECD model does not contain, so that's not contained. The same is dealt with business profits. So in OECD, okay, this can be again MCQ. Okay, you say that independent personal service is taxable as per which model? Okay, under which say for article? Okay, under OECD model. What you say is okay, article 14. Okay, but no, it's not an answer. Okay, it is article 14 of UNMC, but in OECD it will be taxed under business profits head. I hope I am making some sense. Yeah. Then moving on to next one, other income. The article deals with taxation of income which are not specifically taxable under any other article. Right of tax away in OECD is exclusively with IS, and here UNMC, the article which provides a source state may also tax the other income. Okay, right to tax other income. Both OECD and UN model provides that income effectively connected with the PE maintained in the corresponding state by a resident of the other corresponding state. Taxation is governed by the Article 7. Article 7 will discuss what is the State. Okay. Additional UN model provides that if the aforesaid income connected with a fixed base certificate in the contract by a resident of the other contracting state, Article 14 will also be applicable. Article 14 will also be applicable. So I guess 7 business profits for OECD and the in case of OECD is Article 7, which deals with business profit, will be applicable other for also for the other income. And in case of UN model, Article 7 business profits and Article 14 independent personal services will be applicable. Then moving on, next one is elimination of double taxation. That is chapter 5. 23A and 23B exemption of credit method. In many cases, the application of tax credit may result in double taxation for taxpayers. So Article 23 and 23B provides for the mechanisms which is available for relief. Two approaches there. Tax exemption may be available in the resident state for tax returns. You may be exempt from for that tax, okay, or you may get some credit and you will have to pay the rest taxes. For example, generally the interest income is taxable 20% in India, okay, assume, okay, and then it is deducted at 10% other contracting state. What happens is that government loses revenue to the extent of 10%, right? So it says that you can give the take credit to the extent of what you have already been paid. Or else, in both the cases, it is 10%, then the government says that it may be exempt. Okay. These ones are not mutually exclusive. There may be cases where treaty may adopt exemption for certain types of income and credits for other income. So, for some income can be exemption method, some for some it may be credit method, juridical DT and economic DT. Double taxation. Okay, it's nothing but juridical double taxation and economic double taxation. Meaning, juridical DT, the same income is taxable in the hands of same person by more than one state. Okay, assume based on residence principle. Okay, based on residence principle. Uh, okay, a property in India. Okay, a property is there in India. Okay, you are a resident of such some other country, say UN, okay, UK or UN. Okay, what happens is that since you have a building in India and the rental income arises from this particular house property, Indian government taxes it. Okay, since you are a resident of UK government will also tax such income because global income is taxable for resident, right? This happens, right? This is known as juridical DT. Economic DT will be two different persons are taxable for the same income. Okay, for in some country it may be the recipient who have to pay tax. In some country, it may be the seller who have to pay tax. For example, in respect of dividend distributed, a company DT may be payable in company in source state, whereas dividend is also taxable in the shareholders in the other contracting state. Okay, this can be an example. Then DT addressed. Articles, juridical DT is being addressed. Articles does not address economic DT. It has to be addressed via bilateral negotiation. While juridical DT is being focused in this models, and economic DT is left to be decided based on bilateral negotiations. Then moving on to the sixth chapter, that is specific provisions. Mutual agreement procedure map. Where a taxpayer believes that the treatment accorded by either of or both the contracting states is not in accordance with the provisions of the tax treaty, the article provides for dispute resolution. So whenever there is a dispute, we go to competent authorities for appeal, like such things, right? So likewise, the procedure is given there in map through bilateral negotiation between the competent authorities of the both contracting states. Request for map, the taxpayer has to make a request to either contracting states. Okay, in OECD model. But in UN model, a taxpayer has to approach resident state or the country of his nationality. This is alternative A. Alternative B is that reference to an arbitration process is a part of MAP. This is arrived at through the process binding unless the person directly affected does not accept it. So either you have to go and approach the resident state competent authority or the competent authority of his nationality. Alternative B would be you have to go with arbitration process unless and decision has to be binding unless there is a person who is directly affected is not accepting it. Okay, time limit is that 2 years from the date all the information is required by the CAS in order there is competent authority in order to address the case in to be provided by to both CAS. So once every document is being submitted to the competent authorities from that date within 2 years, there's a time limit. Okay, the arbitration may be initiated by the competent authorities if the competent authorities are unable to reach an agreement on a case within 3 years from the presentation of that case. This is alternative A, it is 2 years, and alternative B, it will be 3 years, okay, from the date of presentation. If the competent authorities are not able to come to a conclusion, who can request? Who initiated the case can request for arbitration. Arbitration may be requested by the competent authorities. Okay. One is if the request is made, taxpayer will be notified. Okay, in alternative A, the person who initiated the case has to go for arbitration, request for arbitration. And in alternative B, it is like the competent authorities has to request for arbitration. And then departure from arbitration, no specific provision is there. Okay, in the UN model, there see competent authorities may depart from the arbitration decision if they agree to do so within 6 months. Within 6 months, you can within 6 months from the date of communication, you can depart from the arbitration decision. The competent authorities may decide among themselves. Okay, the last one is that exchange of information. It's the last article. Purpose of Article 26. In order to complete tax cases, a country may require certain information which may be available to the tax with a treaty partner. Okay, one partner may have that one set of information. The article provides for the information may be exchanged in the manner in which such request has to be made. Okay, it's what does this article? What is the purpose of this article? It states that what are the information which may be exchanged and what is the manner in which such request has to be made. What is the importance of this article? Why this article is there? It facilitates effective communication. It curtails the cross-border tax evasion. Once you know what are the incomes you have, then you will be able to reduce or avoid the cross-border tax evasion. Curtails the capital flood is often accomplished through tax evasion. This is particularly relevant in the perspective of a developing country. Similar provision contained in OECD and UN model conventions. A contracting state cannot be expected to provide confidential financial information to another contracting state unless it has a confidence the info will not be disclosed to unauthorized person. So unless it has a belief that it will not disclose to other unauthorized person, it will not share the confidential information. The contracting state can avoid the exchange of information obligations by showing that the info pertains to communication between an attorney and his client, which is protected from the disclosure in the domestic law. If it is between a lawyer cannot disclose his client details, right, unless it is needed by the law. So that's what he can communicate it. Then lack of interest or use of such information cannot okay, lack of interest or use in such information cannot, however, form the basis of contracting states to not to cooperate with the EY obligation. If you don't have the particular interest, that you will not do it. So that's not a reason for which to escape from the EY obligations. So with this, yeah. Now closing, let's have a look at this one. Okay, a mnemonic to remember all these articles. Okay, let us know the persons and taxes covered for those residents and also have a permanent establishment. They earn business profits and IRFC via independent personnel services. Also, their other income can be computed using the exemption or credit method as per the mutual agreement procedure for which exchange of information is mandatory. Let's repeat. Let us know the persons and taxes covered for those who are residents and also have a permanent establishment. They earn business profits and IRFC via independent personal services. Also, their other income can be computed using exemption or credit method as per the mutual agreement procedure for which exchange of information is mandatory. This is just a mnemonic, like just a thing to know the order, okay, order of articles. Okay, okay. It's not a sentence, but just a word. I mean, sentence to remember the order of the articles. Okay. Then, now, these are the article numbers. Let's have a look on it once and then we will wind up the session. 1 is for persons covered. 2, taxes covered. 4, resident. 5, permanent establishment. 7 is business profits. 11, 12, 12A, 13, 14. 11, interest. IRFC, right? Interest, royalties, fees, capital gains, independent professional services, and other income. Then we have the exemption method, mutual agreement procedure, and the exchange of information. It's very simple. Persons and taxes covered, residence and permanent establishment. Here, if you see 1, 2, 3 is not there, 4, 5, 6 is not there, 7, 11, 12A, 13, 14, 21, 23A, 23B, 25, 26. Okay. 1 is persons covered, 2 taxes covered, 4 resident, 5 permanent establishment, 7 business profits, 11 interest, 12 royalties, 12A FTS, 13 capital gains, 14 IPS, 21 other income, 23A exemption method or credit method, and 25 mutual agreement procedure, 26 is exchange of information. With this, we are winding up the session. Hope you find this useful, and yeah, thank you. Do share with your friends and like it.